I think there are a multitude of pulls so far as the rupee at least is concerned. We just saw the Fed policy where the Fed was relatively more hawkish. The market is actually waiting for the ECB policy. Now the whole expectation is that the ECB is likely to announce some measures so far as their withdrawal of balance sheet accommodation is concerned, and that is the reason why we see the euro relatively stronger vis-a-vis the dollar in the global financial markets today, and that is possibly keeping the rupee in check. However, I think if the ECB is not as convincing as the Fed in terms of the monetary actions going forward, there can be once again some amount of dollar strength which is likely to lead to emerging market currency weakness. The BOP data that we saw yesterday also sort of looked okay for the Q4. But going ahead, if oil is sticking at around say a $70 to $75 a barrel, that should create a negative atmosphere in terms of the current account deficit. We are expecting current account deficit to go higher at 2.7%. The critical problem remains so far as the capital flows are concerned, especially the debt flows, simply because if the expectation is for a currency depreciation, then the interest rate differential is not good enough for the foreign investors to actually come into the country. So that's the other thing that we are looking at. Overall, the atmosphere so far as inflation is relatively weaker. There are certain question marks being raised on also the fiscal aspects for the economy, and everything taken together and overlay with that in terms of the elections that we should be factoring in soon doesn't really look too good and robust for the currency. So overall, we are expecting currency to move towards the 69.50. But having said that, I think the critical assumption that we have, or the critical view that we have, is that the ECB might not be able to be as aggressive in raising interest rates as the US, which necessarily means that the dollar should be relatively stable at around the current levels, and there could be some amount of a pullback in terms of the INR, especially in the fourth quarter when actually the services flows significantly tend to pick up. So broadly, I think a 67.50 to a 68.50 or a 69 on the other side should be the broad range of the currency. Coming to the bond market, I think most of the higher inflation and the tightening of the Reserve Bank that we are expecting, a significant amount of that has been factored in. In-house, what we are actually looking at is about 3 increases total in this year, of which 1 has been done. Initially, we were looking at only 2 increases, of which 1 was done, but we have now sort of started looking at 3 increases because for us, I think the core inflation, and that's what the reading that we have from the RBI's monetary policy statement also, that they are quite crucially looking at the core inflation, which looks to be higher than 6% at this point in time. Even the reading on the WPI that came out, core has actually increased to 4.4% from a 3.6% last month, which clearly sort of alludes to the input cost pressures that the RBI had been talking about. So the overall atmosphere is quite conducive enough for the RBI to actually raise interest rates a little more aggressively than what we had been earlier sort of thinking, and they would possibly want to do it as early as possible because gradually we are likely to get into an election phase, which is likely to probably prevent RBI's hand in terms of any monetary policy action at that point in time. Well, at this point in time, I believe that the overall fiscal will continue to be maintained as per the budget. And I think the critical reason is that if you have everything else worsening, your current account is worsening, your inflation is worsening, from a rating agency's perspective, the government would definitely not want the fiscal to be worsening. Now, to that extent, it might actually mean that there can be a cutback in terms of the capital expenditures that they have announced in the budget. Once again, there has been a bit of a change in stance so far as Air India sale is concerned, which is the biggest chunk in terms of the PSU disinvestments receipts that the government had been budgeting at. The other pressure obviously continues in terms of the excise collections that they are doing on the petro products. Our view is that the oil might not be looking worse off from the current levels. Obviously, the crucial sort of bit of information that we are waiting for is for the 22nd June OPEC meeting, where they might actually signal an increase in the supply side. The oil output from US also is relatively strong enough. So broadly, we think that the oil pressures are likely or unlikely to be manifesting in a much more significant way from the current levels. And as I just explained, the INR pressures might not be more significant than what we have actually sort of seen in terms of a 5.5% to 6% depreciation. So given all these conditions, I think the fiscal might not look worse than what they have budgeted for. Obviously, there can be a lot of pitfalls that may be there in terms of how the global financial markets pan out. Suppose we get wrong on the crude oil prices, and so all these things will probably get factored in into the second half of the year. If you want me to sit and take a view at this point in time, I would like to stick to a point that the government would go all out in terms of maintaining the fiscal balances as budgeted.